Good evening. My name is Carlo Garbarino of Bocconi Business School, and also I am director of the Osservatorio Fiscale Contabile that has been established here, and we monitor tax, law, and accounting developments. So today I just spent a few words to introduce the topic and the speakers. I don't have a formal presentation. As you of course know, today we have a great opportunity to discuss the US tax reform and in particular its potential implications for Italian multinational companies. So this US tax reform is not, as our speakers that I'm going to introduce in a minute, has not been finally approved yet. So we are, the complexity of US tax laws, the complexity of the political process, the gridlock effect that we always witness in this situation is staggering. So in a way we are very thankful to our speakers, because it is only a specialist from the US who is able to somehow to summarize this kind of complexity for normal people like us. So it's a unique opportunity. I would like, first of all, to thank tax analysts who has heavily supported this initiative. Cara Griffith, who is their CEO, is not, unfortunately, is not present today, and so she will not be the first speaker. I would like to thank our speakers. The first one is Alan Winston Granwell, who is a Sharp Partner, PA, Washington, D.C., and former U.S. Treasury Department International Tax Counsel, who will be the first speaker. And I thank also Marty Sullivan, who is chief economist of tax analyst, and so is representing tax analyst, even if Cara is not here. So given the fact that, as is usual, we have the so-called academic quarter of an hour, so we were late, and but we are just in time for in respect to the schedule. So I will give the floor to Alan, and you have time until 6:10, and then after that we have time until 6:25 when we will have a coffee break. For the time being, I prefer not to say anything about the reform, because given the fact that we have native US tax lawyers, it would be meaningless. Maybe in due course we can have some questions and discussion. I'll try to be active in that. Alan.
Well, we're going to reverse the presentation, because Marty's going to start, and then I'll...
Okay, you can do that.
You have to be flexible in this environment, or you're not going to survive very long. Thank you all. Thank you, Carlo, for that warm welcome. We are having a great time. I'm Marty Sullivan, as Carlo told you, and I'm representing tax analysts. Cara wanted to be here, but she had to go back to negotiate what's for us a big publishing. We are this will help explain what we do. We are a nonprofit organization. We're nonpartisan. We're really nonpartisan. We criticize everybody, and we don't take donations. We publish in order to generate funds. So we don't have clients. We can say whatever we want, and I have the greatest job in the world, because I don't have to worry about offending anybody, and I do offend many people. Hopefully, I don't offend you today, because the U.S. Congress will do that for me. We are going to give you a quick. Horribly short overview of a 450-page bill that is literally being written as we speak. I was in the hotel watching the markup, and the Democrats were complaining that it didn't seem fair to vote on a bill that actually hasn't been written yet, and the Republicans were trying to rationalize why that might be possible. So not only are we trying to summarize a 450-page bill, we're not exactly sure how it's changing and how it will change. So again, flexibility is got to be called for here. So we are really trying very hard to give you the main points. If you have a particular interest and you don't hear it today, please, I'll be glad to speak with you afterward about that. But we obviously can't cover everything, and there are hundreds of issues in this bill, and I'm not exaggerating the number. I used to work in Congress, and a lot goes on behind the scenes that map individual companies that you should be aware of. Okay, without further ado, I will try to summarize in about 10 minutes and 3 or 4 slides everything you need to know about what's going to happen in U.S. tax reform. And please ask questions as we move along. My first question is, how do I work the thing?
Just close this one. It's on the desktop.
I'm sorry?
Close this page, this file, and there is your presentation on the desktop.
Close like this?
Yeah.
Okay. No.
Your presentation. Yes, US tax reform. The other one.
Okay. Thank you for your patience. And then we'll do a slide.
Yeah. On the bottom right, there is the symbol.
Is this it? I'm sorry.
Close to the minus.
Oh,
Next, left.
I'm sorry.
No.
Okay. Thank you. And to move the slide forward. Okay, thank you. Okay. Thank you for your patience. Okay. I'm sorry. Okay, thank you. Okay. I just want to thank our sponsors. I'm sorry I haven't done that yet. It's SDA Bocconi School of Management and the Osservatorio Fiscale e Contabile. Thank you so much for having us. We really appreciate, and we especially want to thank I'm sorry. Alan, we have
Yes, we'd like to thank Bruno and Francesco and their forum for arranging this, because otherwise we wouldn't be here. So, and I hope we'll do this again if you like a program. So thank you, Bruno, and thank you.
Thank you very much.
Francesco, for all your hard work in working with the university to get us here. Thank you so much.
Yes. Okay. Okay. Okay.
You want me to do it?
Yeah. Thank you. There we go. Okay. Next slide. Next. Okay. Okay. Sorry for the technical difficulties. It's going to sound like I'm using exaggerated terms. We're speaking in hyperbole, but we're not, because the situation is crazy, and we're not using that to create drama. We don't have to create drama. We're just translating what is actually going on in Washington. This is, in the one-word summary I like to use, it's unprecedented. We've never experienced this anything like this before. Alan used to be the chief international tax person at the Treasury Department. I used to work at the Treasury and on Capitol Hill, and we think we know everything about how the process works. Well, this is uncharted territory. So all of our experience doesn't really matter a whole lot because all the rules have been changed. So politically, this incredibly rushed pace, as I mentioned, the bill is being written right now. They're going to vote on it today, maybe later today, maybe not. The Senate, the upper body, may introduce a draft of their bill today, which will be very different from the House bill. So, and then we have a very rushed pace. This is unprecedented. At this time, in 1986, when we had our last major tax reform 31 years ago, it took 13 months from the point of introduction to final signature by the president, and now they're trying to do it in 13 days or by Christmas time. So this is an incredibly complex bill that's going at a very fast pace. And why is it going at a fast pace? Well, it's unprecedented political desperation. You know, Ronald Reagan in 1986, of course, wanted to pass the bill, but and they were many people wanted to pass the bill, but if it didn't pass, it wasn't like their jobs were threatened. They were still going to still be influential in Washington. But the Republicans promised to repeal Obamacare and failed at that, a signature issue for them. And then they said, well, we're really sorry about that, but we're going to do tax reform. And if they don't deliver on tax reform, they are politically going to be extremely vulnerable in November of 2018, which is our next set of elections. So they are going to great lengths to make this bill pass, and they are not really concerned about precedent or formalities. They're just pushing this bill through as fast as they can. There's a lack of transparency. As I said, they're about to vote on it, but they haven't seen it yet. Now they will see. The chairman says, "Well, you will see it before." You know, so here's 450 pages of technical language with cross references, and figure out all the implications of that, and we'll vote on it 2 minutes later. You've had your chance, and that's sort of the top-down approach that is happening right now. Also, we have unprecedented partisanship. The Democrats and Republicans have always been, you know, argumentative with each other. But in 1986, this is very important, I think, when you're trying to understand the longevity of this bill, if it ever passes. This is a partisan bill. It's only one party. In 1986, it was bipartisan. So when you talk about whether, is this bill going to be, if it does pass, will it be stable? Will it still be around 5, 10 years from now? It's very unlikely, because at some point, the Democrats may come back to power again, and first thing they'll do is change this bill. So I wouldn't count on it being, if it does pass, being around for 10 years at all. And then within the Republican Party, it's very important to note that, and you see it all over the world, you have your traditional conservatives who are pro-business and like to cut tax rates on the wealthy. And now we have embodied, most notably in President Trump, a new populism where the emphasis is on tax cuts for middle-class, working-class people. They often say we're going to give tax cuts to hardworking Americans. And I said, well, what about me? You know, I don't know, you know, it's terrible. But the other aspect of it is we also have dynamic macroeconomic revenue estimates. Now this totally changes the landscape, political landscape as well, because the Republicans can argue that it's a $1.5 trillion tax cut, but it doesn't really cost anything because there'll be so much economic growth that will come from this that will have extra revenue, and that will allow the budget to be balanced. And so we've never had this before. This has never been part of the formal process, and so they're going to be very, we don't exactly know how it's going to work technically as they work through the legislative process. And finally, unlike 1986, there's substantially reduced fiscal space. In other words, we have a lot more debt now than we ever had in the past, and our government's fiscal stability is not what it used to be. This slide shows from 1967 through 2017, and then projections into the future, the federal deficit to ratio of the federal deficit to GDP. I was going to show you, in the interest of time, another slide which kind of conveys the same message. This is the level of debt, the accumulated federal debt of the United States to GDP. So if you'll just look at it's from 1967 to the vertical line is the present. And so if you look at 1981, when Ronald Reagan had his famous large supply-side tax cuts, our debt to GDP ratio was less than 30%. So if you cut tax, and then because of those tax cuts, our deficit went up, and we were very frightened. Oh my gosh, it's at 40, and what are we going to do? And moving forward in time, we had tax increase in 1990, tax increase with the first George Bush, And then we had a tax increase with Bill Clinton in 1993. And then the deficit started to go, the debt to GDP ratio started to go down because of the economic boom at the end of the decade, the dot-com boom. And at that time, there were our projections showed that we were going to eliminate our debt. We were going to have no debt because our economy was growing so quickly. So George Bush II came into office in 2001, and he had a major tax cut, and that was justifiable because we didn't have any fiscal, it was blue skies as far as the eye could see. And then we moved forward in time, and we had of course, we had the financial crisis in 2008. And something that, I'm an economist, what scared the heck out of me was we doubled our debt to GDP ratio in 3 years. And so it was extremely scary because we'd never been there before, and we didn't know what was going to happen. Apparently, it's not so bad, the way the stock market is going. But the main point, the two main points here is we're now at 77% debt to GDP, and the projections, of course, for the future with our aging population, the entitlement programs, Social Security and Medicare, the costs of that are going up and are at an astronomical rate. And so why would we have a tax cut in this? You can see why we had it in 1981 or maybe in 2001, but in this situation, to be having a tax cut is kind of not intuitive to most people. So, next slide. So why are we having a tax cut now? Because this is the Republican signature issue. It's just that simple. They've promised and promised and promised, and they say, well, we can't do it because Obama is president. And now Obama is not president. It's that simple, and now they have to deliver because they've been promising. And so that brings us to this complicated legislative process. We don't have a parliamentary system. We have to be special. We have to be different. So I just want to explain this process to you so that as we move forward, where we are now, and as you move forward, you can know when to, or what the flashpoints are for change. So in the broad big picture of it, we first have a budget process. We spent all this time through October just talking about the budget, and we didn't even talk about substantial tax issues, that tax lawyers would talk about. We were just talking about what are we going to do about the budget. And that took till October 5th. And this is extremely important for understanding the process. They got, the word is reconciliation, and what all that means is they set up a special process whereby they only needed 50 votes in the Senate. There's 100 senators, and normally under Senate rules you need 60 votes to pass anything. But under this reconciliation process, you only need 50 votes to pass in the Senate, and since you only have 52 Republicans, that's pretty important. So looking at it from 10,000 feet, and the way many Trump supporters look at it, they go, well, the Republicans control the House, the Republicans control the Senate, the Republicans control the White House. How can you not do what you promised you were going to do? They didn't repeal Obamacare. Okay, they're already angry enough about that. If they don't deliver on the tax cut, they can't understand why it's not happening. And so that was October 5th. Then on November 2nd, which I believe was 1 week ago today, we actually started talking about tax issues. And that was the release of what we call the chairman's mark. In the lower house, the House of Representatives, the tax writing committee is called the Ways and Means Committee. And the chairman of that committee puts out his mark. That's what was released on November 6th, which includes the famous, the notorious 20% excise tax that Alan will talk about a little later. And so that is really the beginning of the tax reform process, because if we go to the third step, Ways and Means Committee markup and approval, that is what is happening right now as we speak. They may be actually voting on it now or close to voting on it. And so it's going to get through the Ways and Means Committee on a partisan basis. All the Republicans will vote for it, all the Democrats will not vote for it. And then it will go to the full House for approval. So now all there are now 433 members of the House of Representatives. You need 216 votes to pass. You have 239 Republicans. So it's fairly certain that it will pass in the House of Representatives. If it doesn't pass the House of Representatives, that's a big, more than a flashing yellow, it's a flashing red light. If they can't pass the House, it probably won't pass at all. So, but we're only just at the beginning of the process at this point. So then we have to go to the Senate. And this is the next flashpoint that you want to pay attention to, and it actually may occur tomorrow under this compressed process. And what makes it complicated is normally they go in sequence. First the House goes, then the Senate goes. But because the Republicans are so politically desperate, they're sort of starting before, the Senate is starting to move before the House is sort of like a relay race where you start running and you hand off the baton. They're getting a running start so they can keep to the schedule that the president has wants to move this along very quickly. So we're going to see a Senate bill from the chairman of the Senate Finance Committee, which will be different from the House bill. So it may be released. It may be released as I speak right now, and we'll want to take a look at that. That's the next big flashpoint. So we have the House bill. The Senate bill will be different. So House bill number 1. Senate Finance Committee mark from the chairman, who is Orrin Hatch of Utah, number 2. Then in the committee, the Senate Finance Committee, unlike the House of Representatives, there will be votes, and there's more likely to be a lot of amendments adopted because they work in a more bipartisan fashion. So when they finally pass it through the committee, the Senate Finance Committee, that's number 3. That's number 3 flashpoint. There will be major changes. Then it goes to the Senate floor for the full Senate approval, and if they can get the 50 votes, but there will be amendments on the Senate floor, and so when the Senate floor bill is finally adopted, that's step number 4, you may see a different bill. So at each of these stages, it's going to change. And now at the end of the process, you're going to have a House bill and a Senate bill, and they're going to be different. You only can have one law, you can't have 2 laws. So you have to have a conference committee, and they have to reconcile those differences. Step number 5, where there could be major changes. So until they go to, a lot of times in the history of U.S. tax policy, it's in conference, after all of this has taken place, that the real negotiation will begin. So you can see how early on we are in the process. We don't know what's happening because it's moving so quickly. We don't know what's going to happen because there's so many opportunities for change. We apologize for our lack of certainty on these points. I know everybody wants it, but it is an unprecedented situation. I mentioned reconciliation, and the good news about reconciliation for the Republicans is they only need 50 votes. The bad news is they've allowed themselves a $1.5 trillion tax cut, but they cannot go over that by $1. That would break the reconciliation rule, and then it would require 60 votes. So they're not going to go. So right now, as we speak, Chairman Brady is, he's over budget. It's like $1.56 trillion, and he's got to get it down below 1.5, or the whole process collapses. So again, if you really have to know about this, the inside baseball to understand how this works. I'll only mention there's, on the individual side, the rate structure. We have 7 rates now, progressive rate structure, top rate 39.6. The House bill has 4 rates, 12, 25, 35, and 39.6. 39.6 is our current top rate. So it is absolutely incredible, even a month ago, if you told me the Republicans were not going to reduce the top marginal individual tax rate in a major tax reform. But it's the pressure from the populist wing of the party to deflect the criticism that they're helping corporations and wealthy folks. It's the new populism that's embodied in Trump. Trump has said, I cannot live with this bill, the House bill. So again, always this pressure, traditional Republican pro-business versus the new populism. The signature issue of this bill, as you all know, is the reduction of the corporate tax rate from 35 to 20%. We don't need any explanation about that, but actually there are some issues that come up. When will it begin? Well, the House bill says 2018, but now they're talking about delaying it for 1 year because they need the revenue. And so that's going to be a controversial issue. And then also, we'll talk more about it in just a moment. They may have to phase it out after 10 years because under reconciliation rules, you have a $1.5 trillion tax cut over 10 years, and that we call it the revenue window. But then under what's called the Byrd rule, you'll hear this all the time, you have to be deficit neutral thereafter in the estimates. And that means you have to let these tax cuts expire after 10 years under this rule. So it is possible that we could have, even though everybody's talking about 35 to 20, it wouldn't be out of the question that we go to 22.5 or 25 as this process moves along. It also wouldn't be out of the question that we either delay it for 1 year or phase it in over 5 years, and then we may have to phase it out at the end of the period for technical budgetary reasons. So stay tuned. We just don't know.
Can you go through the budget numbers?
Yeah, sure. Here we go. Just to give you another, something, I'm an economist, I like to look at the numbers. It's easier for me to understand. So instead of looking at the statutory language, let's just look at the numbers. And it gives you sort of a view from 10,000 feet about what's going on. These are 10-year revenue figures. Now this is from 1 week ago when we left Washington, D.C. These numbers have changed, but let me just, and I'll tell you how they have changed, but just to give you a flavor of what's going on you divide the bill into 3 parts: what's happening to individual taxpayers, what's happening to domestic business, and what's happening with multinational firms. And on the individual side, we have $4 trillion of tax cuts over 10 years, with $3 trillion of base broadeners, getting rid of dozens of credits and special deductions to pay for the lower rates. And so the net tax cut is about $1 trillion for individuals over the 10-year period. Now for domestic businesses, it's a pretty good deal. That 35 to 20% rate is very good. There's also a special 25% rate for pass-through entities, which we could spend 3 hours talking about, but we'll give it 3 seconds. And of course, in the United States, there's much more, a larger proportion of our businesses are pass-through entities and not corporations, so it's much more important politically and economically, that 25% rate. So there's the 1.5 trillion, the orange downward bar. We have $1.5 trillion of tax cuts. That's mostly the rate cut from 35 to 20. Then we have all the base broadeners. We have getting rid of deductions and different credits that you traditionally see in these types of proposals. So the net business tax cut is $843 billion. So it looks about even. Individuals get $900 billion, businesses get 800 some odd billion. But it really isn't even because individuals pay about 10 times more tax than businesses do. So proportionately, businesses are getting larger tax cuts than individuals. The point here politically is that this bill is tilted heavily in favor of domestic business right now. And that's very important going forward because that may not be sustainable because politically that's not popular. People would rather have corporations don't vote, and politically you would want to give tax cuts to individuals. On the foreign side, this is very ironic because we have the move to territorial taxation, which we're finally catching up to the rest of the world, and that reduces revenue. But then we have this by $224 billion. But then we have $509 billion of revenue increases on multinational firms, both inbound investors into the United States and US companies investing abroad. So the net it's a net tax increase on multinational firms, which is ironic because this whole process started about 5 years ago. It wasn't a groundswell of populism that moved this bill. It was the steady lobbying of the business community who were pushing for lower rates and a territorial system. But of course, whether a territorial system is favorable or not favorable depends upon the all-important anti-base erosion rules. And just finally, to break down that little foreign piece now, there's there's maybe 15 different provisions in the international title of the bill, but there's 5 major ones in terms of numbers. So we have a $205 billion tax cut by moving to territorial taxation, but then we have the repatriation of that $2.6 trillion. It's going to be at 2 different rates, 12% for cash, somehow defined, and 5% for everything else. And that turns out to be $233 billion. Then we have the minimum tax, which is what we expected, or what's called the minimum tax, which is 50% of your excess profits subject to a 20% rate. And so that's 10%. Journalists call me up, like, I don't see any 10% in here. And I go, it's 20 times 50, and then they understand. So that was expected because that's been part of prior bills, and there have been many proposals like this from the Obama administration, from Democrats, and from Republicans. So there's no easy way to do this. There is no one way of doing it. And this is about as good as any, but it's very imperfect. Then we have interest limitations. We actually have 2 different sets of interest limitations in this bill. We have can you say the word for me? EBITDA, 30% that you have, I believe, in Italy. You have that rule, so we're copying you. And Germany, I believe, has a similar rule. So we're going to adopt something like that. Whether it's exactly the same, I wouldn't venture to guess at this point. And then we also have an interest limitation rule, which is a formulary rule, just in shorthand. And then we come to the excise tax, which Alan's going to lay out for you. And the simple way I think about it, a simple-minded economist, is that it's a tariff, if you will, on imported goods, but only from related parties. And so some people have said maybe there are WTO concerns with this. It might be, and that's beyond my knowledge. But summing all of that up, that's $285 billion tax increase on multinationals. So, Alan?
Thank you, and good evening. I'm going to quickly go through all of this just to come within the time constraints, and then after, if you have questions, we can talk about some of the details. The first one is the movement to a territorial system or something akin to a territorial system, and we call it a partial territorial system because the way this is going to work, it will provide that if a U.S. corporation owns 10% or more of the stock of a foreign, non-U.S. corporation, and the foreign corporation derives active income from sources outside of the United States, which is not what we call CFC or subpart F income, doesn't come within the minimum tax provisions and or the base erosion provisions, then the foreign company, say an Italian company, could repatriate its profits to the U.S. corporate shareholder, and the corporate shareholder wouldn't include any portion of that dividend in its income, which is a totally different system that we have today. And there would be no foreign tax credits allowed in connection with the repatriation, either direct or indirect, which would mean the U.S. now would be pushing to get a 0 rate on parent sub dividends. But that's the first provision, moving away from a worldwide provision. But as I explained very briefly, in order to not tax foreign source income, you have to meet a number of thresholds. The next one is the transition rule or deemed repatriation, and as Marty has indicated U.S. multinationals have close to $3 trillion offshore. If they were to bring that money back now, they would be paying a 35% rate of tax, reduced by a dollar for dollar offset for foreign tax credits. Sorry.
You speak English and sometimes.
Right. Well, I hope I speak. Yeah, right. Thank you. And
Unless you prefer to speak Italian.
well, maybe it'd be better. It would sound better if I could, but in any event, excuse, I have a bit of a cold. But if you could bring that money back at a reduced rate, then the shareholders, the corporation would be happy. And what is occurring now is, in transitioning to this new system, this partial territorial system, U.S. corporate shareholders can bring the money back at a 12% rate if it is cash or cash equivalent, or at a 5% rate if it's, for example, investment in other stock of non-U.S. companies or plant and equipment. And you can pay for it over an 8-year period. The earnings that are being brought back are earnings accumulated post 1986, determined as of 2 dates, either November 2nd or December 31st, in order to prevent gaming. And this is a deemed repatriation. This will occur in 2018, whether the company actually moves the money or not. And then the foreign company, to make this effective, has to distribute the actual earnings, which would be subject to local withholding taxes, and their foreign tax credits given for all of this. The opportunity here is for multinationals under our very complex earnings and profits rules to make certain elections and try and through various techniques reduce the amount of earnings and profits, or particularly the cash equivalent earnings and profits that would be brought back. Okay, the next one, again, is a CFC provision, which is what Marty talked about as the high returns. And to put this very simply, and there's a lot of detail in the slides, which you can read, but essentially, this is meant to deal with high-value intangibles. And let me give you perhaps the simplest example. If a U.S. corporate taxpayer created, and I'm using this intentionally, an Irish corporation, and the Irish corporation either received or created an intangible. Let's forget how it gets there and all of that. And that intangible produced income through royalties. That royalty, say of $100, would be viewed as a foreign high return and would be subject to a tax under the minimum tax provision of 20% on half the income, or $10. Does everyone follow that? 100 times 50 times 20. And that comes out as what we call subpart F income. It just is includable in the income of the U.S. corporate shareholder. But you can then utilize 80% of the local taxes. Well, it so happens in Ireland, as you well know, that the corporate rate is 12.5%, and it also so happens that 80% of 12.5 is 10. So if you were doing this in Ireland, you would not be paying any residual U.S. tax. The way this provision works is it's a global averaging. So if you have 100 CFCs, you average it and you go through the various computations to see what your minimum return is. So it becomes quite complex in terms of calculation. 2 points I want to make. First, the deemed repatriation and the high return provisions apply not only to corporates, but to individuals and pass-throughs that own foreign corporations. Because under the new partial territorial system, that only applies to a U.S. corporation that owns 10% or more of the stock of a foreign company. If I set up an Italian or Swiss or whatever corporation, I'm subject to the general rules, but in addition, I'm subject to the high return rule, and I'm subject to the deemed repatriation rule. Okay, the interest one is, again, quite technical. It will kick in December 31st, 2017. We have a new concept of an international foreign reporting group, which is a group which earns more than $100 million on average over a 3-year period. There are two limitations, either the new 30% of adjusted taxable income or 110% of the U.S. corporate share of the IFRG's global earnings before interest, taxes, depreciation, amortization. And I'm going to pass by so I can get to...
Those provisions provide... Excuse me.
Right, go ahead.
Those provisions... One of the themes of this bill on the international side is we have separate rules for outbound and for inbound companies. And these rules are more symmetric, I would say. They apply to both inbound and outbound U.S. businesses.
Right, and this is meant to level the playing field. And this other one, this excise tax, is also meant to level the playing field. And some have questioned whether this is really the U.S. version of the U.K. diverted profits tax. In fact, I got that question from the creator of the U.K. diverted profits tax. But it seems to me, even though that may be partially the case, it's really for revenue. And let me explain very simply how this one works. If you have this international foreign reporting group, so it applies to inbounds or outbounds, foreign headquartered or U.S. headquarters, it doesn't make a difference, and you have, say, an Italian company that produces a product which it sells to its U.S. distributor, and it transfers that product pursuant to arm's length pricing, and it transfers the product outside of the United States. So the Italian company doesn't have U.S. source income, and it doesn't have a PE. It has nothing in the U.S. It's offshore. What this new provision provides is, first of all, and it applies to other payments which I'll get to, but the first thing it provides is that the payment by the U.S. distributor of the product, or the purchase price of the product, which we would view as cost of goods sold, when the U.S. company then sells it, it gets a reduction to achieve gross income, and then you put in deductions. But the cost of goods sold either would be subject to a 20% excise tax, a new tax, non-deductible by the U.S. company. So it's 20%, say, of 100 of cost of goods sold. Or the Italian company would elect to be taxed on as if it were in a trade or business in the United States through a permanent establishment. And those of you who work in that area know what that means is that the foreign company is subject to what we call net basis taxation. You take your gross income, you reduce it by properly allocable deductions, and you pay the corporate rate, say the new 20% rate, on the net basis. So,
even if you have no physical presence?
That's for sure, under the new proposal. So basically, and it's an irrevocable election. So if you do that, there's another little tax that applies in the US, it's called the branch profits tax. And again, going to my $100 example, if the US distributor paid $100 for the inventory, which is its cost of goods sold, and you have $100, and you then will have a notional deduction, which is a complex sort of a determination. It's not your actual deduction. a notional deduction, and you get certain returns excluded, and you pay tax on that net amount of income at a 20% rate, which means you have to file a U.S. tax return and all the crazy forms that are affiliated with that, and there are all sorts of forms that go along with this, which we don't have time to talk about. Now, initially on Monday, there was no foreign tax credit given for this payment by the foreign company, which would mean you have double taxation, international double taxation. A few days ago, the Chairman Brady put in a provision that you get a partial foreign tax credit, which is equal to 20%, the lower of 20% of foreign taxes paid in Italy, if that were the case, or 50% of the international financial group's profit margin, if I'm understanding this correctly, based on a product line basis, the lower of. So you would get a partial foreign tax credit. Now, what is interesting, just in finishing, and then before we get to the revenue issue, this provision applies not only to payments to acquire inventory, it applies to services payments, royalty payments, payments to acquire depreciable property. It doesn't apply to interest, or if you don't have a cost markup, it doesn't apply to commodities and other products sold on exchanges such as oil or bananas or coffee or things like that. And that was because of the effective lobbying of people who would be hit by that. But this provision, going back to Marty's chart, would have raised what?
154 billion.
And why don't you take it from there?
Yeah, well, thank you for the hard part. When, as Alan said, on November 2nd, which seems like a million years ago in tax time, the original chairman's mark had this excise tax, and you see it's the fifth item going from left to right. It was the biggest revenue raiser in the international provision of the bill, besides the repatriation. So, and then with the addition of the foreign tax credit, at least there was a lot of uncertainty about, certainly that alleviates a lot of the pressure on the excise tax, but it's unclear how much that is going to alleviate the pain of this new excise tax. The revenue estimators are estimating, it cuts the tax increase maybe by almost 90%. But I've been a revenue estimator, and you don't really have a lot of hard data on this stuff. So I think the reaction of the business community, folks experts such as yourselves, can have an impact on this bill, because believe me, the members of Congress do not understand what's going on here. And even the expert economists, such as myself, believe it or not, do not have a magic crystal ball to understand the implications of all these provisions. We're in a state of very high uncertainty about the fate of this.
And it's possible, because we're a little over time, that the Senate may drop this, but then they have to make up revenues from elsewhere. Just two other points on this. This is very similar to, if you've been following all this business, our border adjustment tax on imports. It's a little different, but it has sort of the same sort of taxation of foreign persons who have nothing to do in the U.S. It said this will increase the cost of goods. I mean, you can imagine how this would apply to an integrated supply chain of automotive parts. And being here in Milan and having worked in the luxury brands industry, this is not exactly a positive thing, as opposed, and then you have the normal widgets and services and whatever else. This was the bombshell provision, and there's fierce opposition to it. Just one other point, and then we will finish, on other miscellaneous items. There may be the possibility that individuals, if everything works out, and it's a big if, will be subject to a territorial system and not worldwide taxation. That may happen. The people, the proponents of that are saying the revenue estimates don't lose money. There's also the possibility that if this bill gets to conference, which is a ways away, someone like Rand Paul, one of the senators, may put in a provision to repeal FATCA. You would like that, eh? Well, then we'd have to figure out what to do with CRS. And then the third one is, for those of you who invest in real estate, there's, and I don't think it's going to happen, the repeal of FERPTA, our crazy real estate provisions. So lots are going on, and I'm sure we'll be talking about the excise tax, but let me turn it over to our chairman, and sorry for going through this for a few more minutes.
Yes, we are on time. Just I would like to add a few comments, and then we shift to the Italian perspective, of course. Well, I am not a sympathizer of Trump personally and of the Trump administration. Clarification in advance. But reading these slides of yours that clarify a little bit better than the reports that have been circulating in the last couple of weeks, I must say that sounds something pretty familiar to us as Europeans. So essentially, you introduce the EBITDA system for the deduction of interest. You take away these crazy systems you had in which you had to pay. I mean, of course, you reduce the corporate rate from 35 to 20%, converging, even going slightly lower to the normal OECD rate. You adopt the territorial system, and in Europe has been adopted since the last 10, 15 years. It's a copycat of our territorial system, the European territorial system. You do have, I don't remember its name, this recapture of, of course, you have the repatriation, which is a transitory measure. Sounds very familiar to us in Italy. We had the cooperative compliance. You bring the money back and you pay 10%, and that's it, essentially. So it looks like, and as far as the individuals are concerned, I think is a very mild, non-significant in terms of the rates. I don't know the details about who wins, winners and losers, but it doesn't seem that there is a major change in terms of, other than protecting, of course, the political base of Donald. So, or at least pretending to protect.
You like him because you call him Donald.
Yeah. So it looks like that, we were discussing several months ago the destination-based tax, and we were, and last but not least, the so-called excise tax is something very similar to the UK, what's his name? Exactly. Or is similar to, other mechanism in which essentially when you cannot, prove that there is a PE, you impose a flat tax. We are introducing a web tax, which is quite similar, is very similar to a withholding tax. The only difference is that I understand that the cost that will be received by a foreign affiliated company will not be deducted of the withholding tax as such, but I assume that the price will be increased because of the effect of the excise tax, which is essentially a kind of import tax.
And it's not subject to our income tax provisions.
Exactly, exactly. So, I mean, from outside, yes, Massimo, from outside, I mean, there was a seminal work by Stephen Shea of Harvard and another, and it was, the title was Worse Than Exemption. So they claimed correctly that you had a system of allegedly global taxation, but at the end of the day, you had a territorial system with a lot of flaws. So, I mean, and of course, then you had the lockout effect. Then you had an exaggerated corporate tax. And, one way, in the Obama period, effectively, there was no political will of taxing U.S. multinationals for their global profits, because essentially they got kind of scot-free in the U.S., either because you don't repatriate the dividends, or because through the check the box and other structure you get benefits like losses, even if you don't consolidate the whole thing. So, I mean, it looks to me that this is, of course, I know that the evil is in the details. So, and I totally agree about the craziness of the process. But, you know, in general terms, from the outbound U.S. perspective, makes a lot of sense. I mean, it's in a way against U.S. multinationals exploiting the treasury in the US and at the same time not paying the taxes in Europe or in another source country. I always said that once the United States start taxing their multinationals, then we get even, because if the US exempt the multinationals, then of course they get, sometimes they pay only once in the source country, or in most cases, legally, they get a double exemption. So I'm really surprised to say that, because I was prepared to say, no, this Trump reform is crazy, it doesn't work. But it looks to me that for the corporate taxes makes sense. Of course, there can be problems in the detail. I see Massimo Ferrari. Massimo Ferrari is not from Ferrari company, but from Pirelli. So they make tires for Ferrari. So I just want to make one simple comment, and then of course I don't want to prevent people from the break. Well, just let me know, and I will comment later on, that I tend to agree with all what you have said, but with one huge exception, which is the excise tax. Because this, to me, is it's my personal view, of course, and happy. Well, but I would not underestimate this statement, in the sense that for me it's a complete and full violation of any international principle I am aware of. How can you tax 20% on a tire imported in US? I cannot simply believe it. So I will leave the discussion for but just a quick reaction.
Just to say, this is what we will discuss during the second part of the seminar.
Because I focused my remarks mainly on the U.S. outbound. Then, of course, you have the U.S. inbound and the effect on foreign companies investing in the U.S. So this was my comment. Maybe you have some feedback. I was very frank and...
no, that's the way it should be, because we're very frank in the United States. We're going to make America great again with this bill. Massimo, you said it's your personal view. I think many people share that view, that this is an incredible overreach. And looking at it from externally, as you look at it into the United States, you go, how could you be so the advocate of the arm's length standard for so many years, and BEPS and so forth, and now you come out with this totally unprincipled overreach with double taxation and possibilities of retaliation, and it violates, it's unprincipled. That's the exact word I think is exactly right way to think about it. And the answer to your, or partial answer to your question is, or how does this happen, is that the U.S. government is not uniform. The U.S. Treasury Department, I remember when I first went to the Treasury, I suggested maybe we should do a formulary method. I was almost thrown out of the building. I was naive, even more naive than I am now about things. The Treasury Department just honors the arm's length standard. In this bill and in this administration, the experts are cut out of the process. The same thing happens at the State Department. You can see when Mr. Trump went to China, he didn't even consult with the State Department. He was just going to, and it's sort of the same thing is happening with the Treasury Department. There's a great professional staff with a long tradition of, they understand the arm's length standard, and frankly, when they negotiated BEPS, they did not consult with Congress. So there's really this separation on this principle. So it's not surprising when you look at it, when you see that bifurcation of how it works, how Treasury's been cut out of the process, that we ended up with something that's totally inconsistent with Treasury's prior view, which was the government's point of view, but now with this new movement, all those, we don't care about it, fire principle. It's unprecedented. I'm sorry to eat into the break. Also, I don't think I will predict, if I had to predict, I don't think it's going to last. I think they're going to get rid of it. So, you know.
Okay, we will revert to the excise tax later. We have on paper a 5-minute coffee break. It's impossible to have a 5-minute coffee break. So, but it's up to you. Do you want to go on? I mean, the coffee break is in next room. Given the fact that at 7:30 we are supposed to close to finish, and we have refreshments. So. Given the fact that the topics are so interesting, and I see that everybody is nobody is sleeping, we can go on if you agree. Of course, please feel free to go next room if you need a coffee, a drink, or something. You can go. So we shift topic. And of course, I have to complete my presentations and thanking the speakers. So I invite the speakers to the table. Yes. So we already thanked Bruno and Francesco for making this event possible together with the business school. I would like to thank Giulio, who has inspired this initiative and worked a lot on that. And he is the first speaker. He is back from NYU for a couple of weeks, so we get a good chance of having him. In addition to Francesco Capitta of Macchi di Cellere, Gangemi, who will be the second speaker, I would like to thank two prominent tax directors. I start not in alphabetical order with Zahira, Quattrocchi. I'm sure that with your name you're always last in alphabetical order, who is tax director of Barilla, a landmark of Italian companies, and of course another landmark. It was an Italian company. No. I know. Another landmark Italian company, Pirelli, Massimo Ferrari, is also the tax director. So, of course, I give the floor to Giulio for introductory remarks. Now, assuming that what our friends have narrated to us is true, or will become true, let's see what are the potential impacts of this reform from, of course, an Italian perspective, meaning Italian companies doing business in the US. And then, of course, we will go more in details in this with Francesco, Massimo, and Zahira in the second part. And we aim at finishing at 7:30, so we can make it to have our social moment and the cocktail reception. Although we can have some slight delay if there are questions and there is discussion. Giulio?
Yeah, thank you. No, I just have this one. We will leave that for the other. So, no need to introduction. Thank you, Professor Garbarino, for the introduction. I work here. I'm responsible for the Bocconi Tax Policy Unit, and this year I have the chance to be in the US at NYU Law School, which is actually a very interesting period to be there, especially if you are a tax person. I would like to thank again Tax Analysts for making this possible. Again, so thank you to Martin, and thank you also to Alan for your speeches, and thanks again to Mr. Gangemi and to Francesco for putting us in touch with tax analysts and to the tax director. We discussed a lot during the past days about this tax reform from an Italian perspective. We were many times on the phone calls to be prepared for this event, and actually everything is happening right now, as the previous speakers say. So in my very short presentation, I was supposed to do a very brief recap of what the tax reform is, and especially to highlight the distinctions and what are the revolutionary parts and what are instead parts of this reform which, as Professor Garbarino actually highlighted, and we did not discuss about that before in advance. We did not talk before. We think great minds think alike. No, I'm joking. And so actually, my slides, my presentation, as you will see, it tends to highlight these things, how this part of this reform is actually an alignment to other OECD tax systems, and how instead another part is instead a revolutionary part, a sort of earthquake, and I disagree on that part from what has been said earlier on. So I would skip these ones because probably we don't need what the situation is. I agree that this is a very unique time to have a reform of the US corporate tax system. We are talking about the corporate part of this reform. To have this tax reform pass, because we have a Republican president and a Republican Congress. Both the branches of the Congress are with the Republican majority. So the tax reform has never been more likely to happen than now. I just wanted to highlight what are the three main steps of this proposal. The blue book, the Republican, the House blueprint, in which some of these proposals were firstly advanced, and then we had in April 2017 the so-called Trump proposal, which seemed to get rid of part of the Republican original proposal, and now we have the House Ways and Means Committee's draft of reform, which actually seems to go back to the original proposal with some innovations, although. So just let's go quickly to the main steps of this reform, just to see what it's very interesting from an Italian or European perspective. So the current corporate tax rate in the US is 35%. We are talking about the nominal tax rate, not the effective tax rate. This is very important because it's true that it's one of the highest, but let's see, I mean, it would be interesting to see what the effective tax rate is, also in light of the cash which has been held outside, and the famous $3 trillion. The first proposal from the Republican was to reduce this tax rate to 20%. Then the Trump proposal was to actually reduce it even more to 15%. This, of course, might generate tax revenue losses, which can be compensated through the repatriation. And the current reform actually takes the original Republican proposal and accepts the 20% tax. This is not something, as Professor Garbarino say, nothing so crazy. Actually, what was crazy was the 35% nominal tax rate. The OECD average tax rate is around 22 and 24. So this sounds like indeed an alignment to the other OECD systems. Let's see the other part. It was the basic idea was to align the taxation of any type of business, the corporate and incorporated business. We have in Italy, for example, società di persone, so the unincorporated business, which currently are taxed with a see-through system, and so their income is subject to the progressive personal income tax system, and most of this income is taxed with the highest tax rate, which is 39.6%. So most of the unincorporated business income is currently subject to almost 40% tax rate. So if we lower the corporate income tax to 20%, then we may have been a problem of a sort of disparity with the other type of unincorporated business taxation. And so the Republican proposal originally was to lower, to have a flat tax of 25%. Then Trump say, let's have the 15% also for unincorporated business income. And now the proposal says 25% tax with an anti-avoidance mechanism to prevent certain tax planning. But so again, alignment to the original Republican proposal, and it doesn't sound new, for example, to us, to Italians, because recently actually we just had a reform of the taxation of the unincorporated business, according to which they might be subject to the 24%, the same tax rate as corporate businesses, subject to, of course, which is elective, which is an option. But we also have that, for example, in Italy and in other OECD countries. Then we have the repatriation. I'm not going to go in detail to this, which is pretty interesting to have this 3 trillion repatriated. There may be an accounting issues for US multinational, for example, to justify such a tax. There was a proposal, but I don't want to discuss that because it's not that important from an Italian perspective. The shift to the territorial tax system, we, as Professor Garbarino has already said, this is what already is in place in most of the other OECD countries. We all have a territorial tax-based tax system. The US was actually the exception, so shifting to a territorial system, although it would be a partial territorial system blended with tax on foreign subsidiary excess returns. They've been described already by Alan, but still, this is an alignment to the other OECD tax system. Interest expenses, establishing a limitation to the interest expenses based on the 30% EBITDA. Nothing new. We have in Germany was the first one, as the previous speaker said, then Italy we copied and pasted in a certain way the German provision, and now the OECD actually advanced the reference to the 30% EBITDA. And also the European Union suggested that every country basically adopt the UK also is shifting to this system, so which is now still EU, but we don't know for how much longer. But anyway, it's nothing new. It sounds like an alignment to the other OECD or EU tax systems. Cost recovery. The full deduction in the first year of the acquisition expenses for capital investment, machineries, equipment, and so on. This is a huge deduction, so no deduction based on the applicable life of this equipment. But I mean, we don't have anything like this, at least in Italy. I don't know in other jurisdictions, but for example in Italy and in other jurisdictions, I know that the governments are enacting a lot of tax incentives in the form of like huge tax allowances and deductions, amortization and so on, to incentivize the acquisition of new machineries and new investment. So, for example, in Italy we have the superammortamento, the iperammortamento, basically allowing allow deductions for 250% of the actual cost of acquisition. So the US is way bigger as a measure, but it goes in the same direction in which many OECD countries are going. NOLs, net operating losses. The US had a time limitation on this, on the use of on the carry forward losses, tax losses, and now the proposal is shifting to a quantitative limitation. So getting rid of the time limitation, 20 years. We in Italy had the 5 years provision before, and shifting to a quantitative limitation. So the NOLs are used, can be used up to 90% of the taxable income in a certain fiscal year. We, many countries have this rule. Italy actually 4 years ago, 5 years ago, we switched as well from a time limitation rules to a quantitative limitation rule. We have an 80% limit. So nothing new. Actually is an alignment. So basically, from a tax policy perspective, this reform sounds like, if we list all of this provision again, sounds to me more like an alignment to the other OECD tax system rather than a revolution in terms of tax policy and so on. So an alignment of the US tax system to the other tax systems. Next step, we don't know the VAT. It sounds crazy to the US, but basically that's where we are going. Like we actually, our governments are increasing the VAT tax rate. We are relying much more to indirect taxation. In the US, academics scholars speak about adopting the VAT. Nobody among the practitioners speaks about that. Nobody wants to speak about that. But maybe, who knows, in 10 years, 15 years, we'll realize that the sales tax are not that different, and actually having a common VAT might be more easily manageable for you. But who knows? That was just a provocative point. So where is the tax revolution in this reform, from my point of view? And here is where I partially disagree with what you say. Is actually the use of tax policy as a cross-border regulatory tool. So taxation has two functions. Professor Garbarino knows that this is my main area of research. So the use of tax, not just for revenue-raising purposes, but also for regulatory purposes. So to implement tax policy, to reach trade, to reach social, economic goals, not just revenue-raising goals or redistributive goals. So here is basically what is revolutionary to me. So from my point of view, both the Republican proposal at the beginning, the border adjustment, the destination-based tax, the first proposal, which according to which the exemption from, which were provided for an exemption for income from exports and no deduction for the imports, that was a regulatory tax provision. This way, basically, the goal was to incentivize the domestic production and to provide incentive not to import anymore. I don't know whether and how this would have been sustainable for the US economy. I don't know how many products actually could have been produced domestically. I don't know how business would have found this convenient, but the goal was actually a regulatory goal, a trade goal, and that's why somebody claimed that this would have been against the WTO rules and also against the tax treaty. The Trump proposal didn't say anything about this, and so it seems like that this regulatory tool was actually had been left aside. But now we see that there is the 20% excess tax on payments to foreign subsidiaries, unless they establish this notional permanent establishment, which sounds like crazy to me, because we discussed for 3 years about renewing the concept of permanent establishment, and now the US unilaterally comes up with this idea of a notional permanent establishment. So to me, this is really revolutionary. This is a unilateral regulatory tax policy measure, which actually is a sort of earthquake if it's implemented for real. It's to do actually policy through taxation. And I don't know whether this is going to be against the WTO rules. Maybe yes. I don't know how this is going to be, how the businesses are going to deal with it, and the governments in terms of like tax treaty eligibility. And so this actually, I think, is what it's the main interest from a foreign perspective, especially from a European perspective, because there might be also retaliation issues, because I don't know whether other countries are going to accept something like this, but this to me sounds like the element of the revolutionary element of this proposal. It's like FATCA, also unilaterally deciding to impose a sort of tax on payments moving towards other jurisdiction and other countries. And this might impose actually a change of the business, especially foreign multinational supply chain, if this is enacted. I don't know whether this will be or not, but this for me is the main interest from a EU and Italian perspective. With this, I leave the floor to the other speaker, which I thank again for being here, and I think we agree that this is the most important, because there was an anticipation of this before.
Just make a very short comment. Of course, I agree with what you said and what you say about I'm not a defender of this excise tax. Just food for thought for the speakers, and adding a little bit to what Giulio, to the discussion, Giulio, about the regulatory taxes. Yes, I mean, we can call it, it's like a tariff and it's protectionist, clearly. Yeah, okay, this is, but on the other hand, it can be legally bypassed by moving manufacturing in the US.
So, but this is, but that's, I agree with you. If I can just add a comment, and then we leave the and then we leave the floor.
It's some food for thought, not for fight.
Yeah. No, well, I agree with you, and then we leave the floor to the other speakers, but that's the point. If they do that, the regulatory goal is actually reached, and that's the point. Unless they make the election for the notional permanent establishment, which is completely out of the OECD discourse and so on, and the OECD BEPS works. So we were just, I mean, I think we as international tax lawyers are very interested in this unilateral measure by the US, which might happen or not.
Okay, can you hear me? Yes. So let me start thanking Bocconi, Professor Garbarino, and Professor Allevato for having us here today, and thanks to Alan Granwell and Tax Analysts for suggesting to organize this seminar, which is very interesting for us. And we would like to offer the Italian perspective of the US, of the proposed US tax reform. So we would like to see what are the consequences for Italian companies that have an interest in the US. That's the questions that we have considered, and that we went through the Bill of Law and all the various measures that are proposed in the tax reform, trying to understand where there could be an effect for Italian companies. And honestly, it was not an easy job. We had to change the preparation, the presentation 3 times, because of the law is changing every day. The Bill of Law is changing every day. One of the measures we had considered was a provision on the limitation on treaty benefits that was dropped, I understand. So it is no longer of interest, and we dropped it as well. And finally, we are here, so we have something to say. Although, let me say, if as Martin and Alan said, that you didn't really understand much about the tax reform, I let you imagine what we understood about it. So. Anyway, so among the various relevant measures, we decided to focus on just one, which is the excise tax. And this is the most controversial measure, and the one that is more worrying for the Italian multinationals. So, with this very brief introduction, I want to ask Massimo and Zahira, what do you think is the impact of this excise tax? And we will go into the details of the excise tax later on the other points, but as a first reaction, what do you think about it?
Well, the reaction was shock, obviously, because it's what is really interesting, as Giulio was saying, is that the unilaterality does it exist of the measure, meaning that it doesn't really seem to have let's say a purpose or a rationale beneath. The first thing I would like to say and to point out is that this is applied to a company, a US company, which is a part of a group. So having to deal with a unilateral measure, which basically states that every time you pay, a US company pays something to another group company, has to have the cost of 20% tax, is an issue. Mainly because the company is part of a group which is a part of a tax policy, just looking at the tax perspective. So you know, any kind of remedy you want to find, it will just shift the risk from a country to another. So it really is a matter of does it make sense or not. I was saying during our several teleconferences that Barilla has already got a very big production installment facility in the US. So it's kind of half fit by this measure. But the company has to pay, obviously, a huge amount of intragroup services according to our policy. And that's because it's a part of the company, because it is part of synergy charges because it's part of the transfer pricing policy. So how can we not charge these costs? And if we don't charge these costs, what will happen to the other companies and to our transfer pricing policy? And that's the first point. I will be very short, and the thoughts are common. So just to be in the interest of time. The other thing is everybody in Europe and in the world is talking about transparency in tax. We are dealing with many provisions from all governments, from the OECD, just enhancing the concept of tax has to follow business and not the other way around. And now the US come with this national permanent establishment concept, which is what we don't understand. It's a permanent establishment with which basically is made up just for tax purposes. We don't know what I mean. Just revenues, no costs. What's really the meaning of this? And how can we justify this kind of permanent establishment in the eye of other jurisdictions? If I think about Italy, probably the tax authority will not even allow for the foreign tax credit in Italy because it's not a substantial permanent establishment. So again, it's very complex and complicated.
Thank you, Zahira. Well, let me say that, of course, we could speak really for hours on this excise tax. And just a comment I want to make. I was with you, Carlo, up till All Saint, if I may. So the reform, the first version before this fantastic excise tax was not bad, because when you go in one shot from 35 to 20, and I quote always the UK, which for me is a great example, they moved down the rate in probably 8 years, Mr. Trump in 8 days, so that's fantastic. And also the fact that you can depreciate all your capital expenditure in one shot is, again, very good. And most of the other were not for Italian companies. So honestly, I was not very much involved. Interest deduction, I agree with you, is in line with what other countries are doing. So it was fine for me. The border adjustment tax fell away. We dedicated a lot of time. We tried to understand it. We really invested time, resources, and then it disappeared. So fantastic. Then November the 2nd, here we are with this excise tax, which for me is simply a disaster. I cannot really, well, now I understand it, but really I cannot understand from an international point of view. It doesn't make any sense to me. And it impacts dramatically, really dramatically, well, not Italian, any non-US, because, well, I am with you. You have made 3 comments which make the discussion even more interesting. Well, you can open a factory there, yes, or, but that should not be tax-driven decision, in my view. If Barilla or Pirelli or whoever wants to open a factory should decide based on solid, grounded business reason, not because Mr. Trump basically make impossible to make a deal or import goods, which honestly, this is my personal view. So what we are trying to do is to understand what we can do. In my view, today, the only way I can figure out is to declare a deemed permanent establishment. Then I don't know how to manage it, but I cannot see any other alternative, because I cannot even think pay 20% tax on all imported goods. It's simply a disaster. After November 2nd arrived November 6th, which made me a little bit less concerned, because they did a few things. The first one is the foreign tax credit, which, if I got it right, is not too bad. It's not too bad in the sense that you will get 50% of your consolidated tax rate, right? you need to increase by interest, so your interest rate will be decreased, but still an interesting tax credit. Again, I'm struggling in understanding the rationale of a consolidated tax rate, why we should use a consolidated tax rate, but I get the positive. So it made the excise tax less impacting. Now, I still hope that it will disappear like the border tax adjustment. I hear some rumors, also now they are texting me, saying that it might disappear, which would be fantastic, a fantastic piece of news. My only comment is being realistic and looking at the slide that was shown before in terms of amounts of money at stake. If I got it right, I have here, there is 154 billion of revenues coming from this excise tax. November 2nd, yeah. You are right, and you also said that 90% of this has already gone, probably.
Well, that's what the estimators say.
Yeah.
That's why I'm hanging on every word that practitioners say, because I don't believe the estimators fully understand, like all of us, what the impact is.
But which worries me, because if $154 billion disappears and they are needed to fund the other cut, well, by definition, they will find something else. And considering the trend, I don't know whether it will be something better or worse. So I stop here. Of course, we can speak for much longer, but I stop here. So.
I don't think now it makes sense to go into the technicalities of the rule, which was something that we wanted to discuss, but in the interest of time, we'll skip that. You just have to keep in mind that this is basically an additional tax on the top of the taxes that are already paid in the US by any US subsidiary owned by the Italian company. So the first question I had, we had is, are you making any estimates of this additional tax burden you're going to have first? And the second is, what are you telling to your top management? How is the discussion going on? Are they scared? Are they worried about this?
So no estimation from our side, meaning that it would be completely. So first of all, we only have services, so the issue is much more under control. Let's say, of course, if we would have a distributor, then that would be different. But no estimation, just because the rules are not there. So even if we would try, they don't succeed. Just imagine what can we do. So no estimation. The top management is quite worried, to be frank, meaning that obviously they get and that's much more to do also with what they can read on the newspapers. And I think the message the US are sending is the worrying one. And this uncertainty and this very unilateral and kind of, let's call it pragmatic approach over taxation is a little bit worrying to the business as well, because obviously the business sees this as, comes to us and says, what's the rationale for this, because I don't understand. And if they hear their tax director saying, well, I don't either, it's kind of worrying too. So.
Yeah, I totally agree. In the sense, of course, top management, if you have a large business in the USA, are trying to understand what's going on. I would say we are guessing more than estimated, because it's impossible. Again, November 6 versus November 2 is a completely different world. With or without the tax credit is a completely different world. Now, the point is that we are guessing, no more than guessing. Definitely what we are doing is trying to follow all this evolution. We are in daily contact with, let's say, advisors who are assisting us in the US and trying to follow what's going on. And the message that we are delivering to top management is exactly this one. We are following, it would be in my view, a little bit risky putting out any figure, any estimate, because it doesn't make a lot of sense at the moment. Then, if maybe in 1 week that might be possible, the message that we are delivering to top management, is more on the approach, because of course we need to keep in mind that the approach of the Trump administration is not just on the excise tax. I was discussing yesterday interesting action on the customs area, which I don't know whether are more worrying or less worrying, but definitely worrying. They are renegotiating the NAFTA agreement, and honestly, I've seen some of the most recent position of the US administration, which I would try to define a bit aggressive, let's say slightly aggressive. So the kind of environment in the US is worrying. It's difficult to provide clear messages, and above all, it's, in my view, it's almost impossible to provide figures to anyone.
Thank you. I thought at this point it would be useful to go very quickly how we think the rule as it is now would work. So basically, the rule would catch the situation where you have an Italian parent company with a US subsidiary acting as a distributor for the goods produced by the Italian company. So which is the case at this table. So the Italian parent company sells goods to the US parent company, to the US subsidiary. The US subsidiary sells the goods to the US market. And the rule says that the US subsidiary has to pay an additional so-called excise tax of 20% on the payment that he will make to the Italian parent company. So basically, it's a tax on proceeds. It's not a tax on income. And it's additional on every corporate income tax that the US subsidiary will have to pay on a standard basis. And the taxpayer is the US subsidiary. There is an option, which is, in order to avoid the excise tax, the Italian parent company may elect with the US tax authorities the so-called ECI election, effectively connected income, which means basically to make a disclosure to declare that the Italian parent company has a permanent establishment in the US. And there you have the difficulty of determining the taxable income of this permanent establishment, which is just notional. It doesn't exist. And there is no clarity about how this calculation is to be made. But basically, as a tax practitioner, the first point I see that the Italian parent company, the first decision is to make is whether to pay the excise tax. Massimo already said this is not an option, or to declare that they have a permanent establishment in the US and pay corporate income tax in the US on this notional income. So this is the choice to be made, and you have to make a calculation for that to verify which of the two options is more convenient. One point that Alan touched upon very briefly earlier is you have also to consider in this calculation that if you declare a permanent establishment in the US, there is also an additional tax. It's called the branch profit tax. And basically, it's a taxation that applies on cash that is remitted from the permanent establishment to the parent company, to the head office. And it's it applies like a withholding tax at the rate of 30% of a lower rate under a tax treaty. Now, basically, the purpose of this branch profit tax, Alan, please correct me if I'm mistaken, is to provide an equal treatment for investment through a subsidiary or through a permanent establishment. Because if you invest through a subsidiary, you have taxation at the level of the subsidiary and then a dividend withholding tax. So the branch profit tax works exactly like a dividend withholding tax. So in the calculation, if you decide to opt for the ECI election, declared to have a permanent establishment in the US, you also have to compute this additional branch profit tax, which makes it very complex.
Just to make 2 points, what you said is much better than I could have
You have a mic?
No.
Is there another mic?
The first point is if there is a payment by a U.S. company to a foreign company as a withholding tax, that's under the control of the U.S. company when they make the payment. The branch profits tax is much more complicated because of the determination, so you have sort of timing issues. And the second thing, not to concern you overly, is if you were to make this deemed election, what will be the impact of making that by states of the United States? Because we're now only talking about federal law, and there's a whole issue that has arisen, and the states are very aggressive, as I am sure you two know, as to what they would do in terms of the imposition of a tax, and that would be an additional cost. So I just raised that. I don't know what the answer is there, but it has been raised in commentary in the United States.
Thank you, Alan. The next point we wanted to touch is if there is anything that the Italian multinationals can do to avoid this additional tax. And we've considered this from a tax policy perspective and from a practical perspective, if there are ways to avoid the application of the excise tax. Zahira, you made the point about the lobbying activity. You want to comment on that?
Yeah. I think as was said during our speakers before, I think nobody actually really understands in Congress what this means in practice. I think it's the same as it happens in Italy. You know, when you have a very complicated tax rule being applied by the parliament, and you go and ask to one of our politicians what this means, that they will look at you like big eyes. That I would expect it's exactly the same in the US. So, considering this rush timing that they are proposing, by the end of December we could find ourselves with this law, basically with this bill applied and passed. I think it's very urgent that we kind of find out somebody who actually is able to speak our voice to the right people, to actually explain what it means and explain why this is wrong and what are the parts which are completely totally wrong and against we called it soft law, but anyway, the international rules which are basically guiding tax authorities all over the world.
Yeah, in terms of lobbying, let me give you some suggestions. First of all, there's some organizations, I know the acronym, but I don't know the full name, which represent inbound companies, a wide spectrum which could assist there. Secondly, particularly because you have operations in the US, you could see the members of Congress or the senator who represent that district and tell them about this. And you could talk to the staff. Normally, as Marty was saying, in the old days, if something like this happened, we would have people come to the Treasury Department and speak either to my office or the Assistant Secretary. I don't even know if that's possible anymore. And there are many ways to approach this by talking to the various staffs, and then by retaining lobbyists to speak to the members, or to even speak to the Commerce Department or the State Department, or to get your ambassador from Italy involved in all of this.
I just want to reinforce what Alan said, because the way that the debate is very simplistic. we were in a room of law professors and we're trying to rationalize this. And there's a line from the movie All the President's Men about the Watergate scandal. And I love this line. They say, they're talking about the White House in this case. And you don't understand. These guys are not that smart. You think they're the president and the speaker, and they're all very intelligent. The way I look at this bill is they have a you start at the top. You got $1.5 trillion to spend. And Dan Shaviro, professor at NYU, he just wrote in his blog, they like multinational companies, but they don't love them. And so when you're up against that budget constraint, you say, who are you going to inflict pain on? You're not going to inflict pain on small businesses in America, and they've already sort of they're not really giving a lot of middle-class tax relief. And so I think they said, listen, let's hit the multinationals. There's a lot of political, there's a lot of bad press about them. We're giving them a 35 to 20% rate. Let's go there. And I think they just said to the staff, find more money. But they directed them to the multinationals. Again, they like multinationals, but they don't love them. And I love that. I think it's the way to put it. They didn't get up in the morning and say, let's really hammer inbound investment. But to reinforce what Alan said, and I've talked to members about this of Congress, and it's not a partisan issue when you're talking about jobs in my district. And there are spread throughout the Midwest factories of foreign firms, and that 200 jobs in this town, 400 jobs in that town, and no member of Congress wants to hear that they're going to shut down a factory because he voted for a bill that raised the taxes of that employer. So I think it's very, although the superficial debate is that foreign multinationals have tax advantages that U.S. firms don't have because they can do leverage up where U.S. firms can't do that. And so that's the first argument. But then the second argument is, which overrides that, is you're going to hurt U.S. job creation in my district, and it's very tangible. And I think again, both Democrats and Republicans will really respond to that.
I would like. It would be interesting from our U.S. friends to understand, assuming they know, whether this provision has a straightforward protectionist rationale, like, let's bang them because we want to do protectionism, or alternatively, whether it is somehow inspired to what I referred this destination-based tax against multinationals exploiting the source country. So I completely sympathize with Massimo. I mean, if you have an industrial company with a subsidiary buying, material goods that are being, of course, you need a distributor in the U.S., then this is has a very negative impact. But generally speaking, these kind of flat taxes are imposed on foreign companies that exploit the system, like, excuse me, Google in the EU or things like that. So they do business, they have turnover, and they don't pay taxes because of gimmicks. So possibly an additional way to lobby against this provision is to kind of mitigate it by adding clear anti-abuse requirements. So you pay it if you are extracting income from the US and not paying any taxes. So essentially excluding real industrial companies, because, essentially this is the exception that you should aim at. So, and because we are paradoxically, I mean, the US is paradoxically converging. We were expecting that you were going to diverge completely from the peloton. I mean, the big group of the other countries. Now, you are, flabbergasted. You converge. Okay. Then, if you converge, you can also converge in terms of the, let's call it the web tax or whatever, the destination-based tax that is against exploitation of the system. because and another thing, there is no, as a lawyer, I don't see any line of defense in terms of against the Constitution, state or US, because they don't have a strict, correct me if I'm wrong, requirement of horizontal treatment, so you can make differences. And there is no that I'm positive about that. I'm positive there is no defense under the tax treaty because it's outside the tax treaties, because so it's not an income tax, and possibly there can be litigation at the WTO level because this is against possibly against the WTO. But it would take a lot of time, of course.
Well, the only thing, and I'm not an expert, in the border adjustment tax, there was talk about our 16th Amendment, and there might be the possibility, but I really don't know enough about it. But that
amendment providing for
it really relates to the appropriate base for a tax, of an income tax, but it's something I really don't practice in. But that was raised during the BAT discussion, and there might be some possibility here.
The Supreme Court does not take tax cases, and because the majority is conservative now, it's unlikely that they take a tax case, I guess. But this is.
Question. Can I have a question? Just, I'm quite interested in. Yes, I'm Stefano Guarino, a tax lawyer. I see some problem in terms of double treaty law, double treaty convention dealing with notional PE, because as long as you want to found in a state PE, you have to comply with the convention, otherwise you can't. And the OECD and the US models are based on a kind of a physical PE. So I think that this kind of notional PE is outside of the scope of convention, or at least it could be kind of a side effect for US in terms of seeing PE for US digital economies in Europe, because if you kind of introduce a notion of kind of a notional PE, so PE without a physical base, without a permanent establishment, you kind of you pass this kind of a notion that your countries can identify, can spot digital, so kind of a not based PE, and this I think open kind of a can of worms for the digital models like Google's or so I think. If I may, just one comment building on what you are saying, totally agree with you. Well, just trying I was trying to understand or to find a rationale, apart from pure protectionism, right? But if the Trump administration thinks that multinational importer needs to pay for the market, because this is the only thing I can think of. So you are selling your services and product in the USA, fine, you get 5%, we were mentioning a notional return given or left to the overseas company. All the rest is mine, and apart from a pure, I don't know, appropriation, I would say all the rest is mine because I have the market, which honestly I can try to comment in 1 minute. This is something which is not unique in the USA, because we have seen in the United States, let's say the guideline on transfer pricing in April, I was following because I am particularly interested to the Chinese position, where they are putting forward location saving, basically definition. They are saying, well, who you are selling goods to my 1.2 billion Chinese, and sorry, you need to pay for it. If this is the rationale, which I don't know whether it's the rationale, but the only one I can think of, well, it's interesting to apply to the Google, Amazon,
and so on, because if they pay where the customer is, sorry, it's the end of the game also for them, because the customer are in Italy, are in France, are in Germany, are in Europe. So, well, in terms of retaliation, because if this flies, my expectation there will be a retaliation against the US. And if I were the European Commission, I would seriously start thinking, because I don't think Europe has a lot of gun to retaliate, but the market, the European market, with 300 million people buying all kind of Apple, Google, and Amazon services, is probably something interesting also for the Americans. And if they go down this very dangerous route, well, it might be one reason to take it out and go back to the OECD principle that have been around for the last 50 years. But this is just my thought, and I would be happy to hear from.
Well, I totally agree with you, Massimo. The notion of permanent establishment, the traditional notion of permanent establishment, is no longer adequate. There is consensus about that in the international tax arena. And the discussion now is, where is the value? The value is where the market is, or where the goods are produced. That's the question. And it seems, as you mentioned, that the direction is that of deciding of applying a tax where the buyers are. Speaking about retaliation, the US were not very happy about the EU state aid cases. So the Apple case, just to mention one, there was a very strong reaction by the US government in that respect, by the US Treasury. And the internet, the web tax, as it seems that will be applied by the European countries. There's discussion, as you know, going on about that. So, will likely be similar to this excise tax, a tax on proceeds. Then we'll see which percentage, how to calculate that. But probably the US have unilaterally anticipated the retaliation.
Can I just add that I have been participating in these very heated debates in the US about our EU cases, and they were crazy about that. But the
it's
EU
for the
cases,
recording. Thank you.
I always the Court of Justice cases, I always say that, are not a retaliation, simply applying the principle of equal treatment, with a market-oriented approach. So, in the EU, they are not saying, because you do business in the EU, you have to pay an additional tax. Because you do business in the EU, you have to pay the taxes like the other players, essentially, oversimplifying the story. And so I think that it would be difficult for the EU. I mean, you mentioned correctly, not the Court of Justice, but the Commission. No, it would be difficult for the EU to apply a retaliatory tax.
No, I agree, but if the Chinese follow this principle, the American follow the Chinese, the European must react somehow. So.
And what about what about this crazy idea? I mean, which is anti-Italian or anti-French or anti-German, of moving production into the US?
No, sorry. No, it's not a crazy idea. We have multinational company, Pirelli, just because I'm here, have factory everywhere in the world, from China to Germany, Italy, UK, Romania, and so on and so forth. But they have always been taken based on a sound business rationale. Is there a business rationale to open a factory in Romania or in Italy? Yes, we do it. Here would be a strange process, because maybe we are opening tomorrow, maybe in 5 years, but if the decision on multinational is posed by a tax administration which enact a very protective, if you like, rule or law, let me say that we are entering into a new era, which honestly I don't like very much. Then if the market must be the new OECD principle simply because the Chinese want it or the American. Let's explore. But it's a revolution. It's not an evolution.
Do we have any other questions? No, but I think we can close now. I wish to thank you, Massimo and Zahira, because it was really a learning experience for me. Thank you very much. And thank you to the audience for staying until this late. And we have now a cocktail for everyone who wants to join us.
Next door, on your left.
Thank you very much again.